Hey everybody, welcome to the morning market briefing. It's Thursday, October 27th, 2022. Hope you're doing well out there. Big show today, guys. How you guys feeling?
I'm
big?
good. I am excited to hear what the bad news and good news is from Tom here in a second.
Well, let's jump in there. We do have GDP coming in right now as we speak. The expectation was for 2.4% for the quarter. The previous quarter read at minus 0.6. The GDP now expectation was for 3.1. Tom, talk to us about GDP. What are we seeing?
So GDP, which I would argue is the bad news, because it is good news, is the GDP accelerated by 2.6% this quarter. So coming in ahead of estimates at 2.4, and the prior quarter being a contraction of 0.6%. We're now in a strong, growing economy. And the good news, I would say, though, is if you look at the GDP price index, which is also part of it, which is essentially a read on inflation, the expectation was 5.3%, and we came in at 4.1. And then, of course, core PCE, 4.5 was the expectation. We came in at 4.5. So we're not seeing, thankfully, any acceleration in inflation. In fact, if you look at the GDP price index, which the last reading was 9%, we came in at 4.1%. So there is a little bit of a mixed bag here for the Fed in the sense that the economy is growing, but the good news is that inflation potentially coming down. So that could be a reason for them to either decide that they're doing the right thing, which is that they can continue to raise rates and not hurt the economy, but also bring down inflation, or a reason that they can say, hey, maybe we can pivot, not raise so much because we're seeing the progress we want to see, which is that we're seeing a little bit of a come down here in the GDP price index, and the economy is also continuing to grow. Thoughts?
At a high level, I think you're kind of right on good news, bad news. We've definitely seen worse reports as of late, whether it was negative GDP with accelerating inflation pieces. This is not terrible. So we'll take that, I guess.
I mean, that's the definition of a soft landing, right?
I think if you look at the core price index, you're talking 4.5%, which is still belower than 4.7 in Q2. I would say, I think that, this is a quarterly number. The Fed is not going to be watching the price index as closely as maybe on the CPI side and the PCE on the monthly side. I think on the GDP number, I think they'll be encouraged by the fact that residential fixed investment basically really drove the GDP number lower than it otherwise would have been. New single family construction was down, brokers' commissions were down, private inventories were down. I would say, though, going forward, what levers does the Fed have to pull in terms of bringing that inflation down? Because if the housing market is already kind of collapsed in terms of number of transactions, and you're already getting some of these reductions, and you're getting some reductions in inventory, and you had some of those liquidations of inventory, if inventory is right sized and going into Christmas, then you're going to have price increases going up again. So I don't think the Fed's job is done. I think that the market reaction could be good, though, on this in terms of being able to grow and actually see inflation come down at the same time, exactly as you said.
Yeah, the bond market is not really reacting at all.
Yeah, I was going to say, same on equities. There's some slight gyrations that I would say on the futures side are trending positively. When we started the call, Dow futures were up 68 basis points. Right now they're up 86, but it's kind of bouncing a good bit. But a little bit different than some of the calls lately, I feel like, where we've had economic data. There's no move for a few minutes and then it just plummets. So Dow futures holding up pretty well. S&P futures were slightly negative heading into the call. They're up 10 basis points. NASDAQ futures down 49 basis points, but they were down more when the call started. We'll maybe check back in on that when we come back. But at least at this moment, not a pronounced negative as it relates to equity.
Yeah. So in the bond market, 10-year started today right at 4%. As we approached 8:30, it ticked up to about 4.08. And as soon as the number came back, went right back down to 4. So it basically unchanged, but it was anticipating bad news. And then the result is essentially nothing, which is, that's really all you can ask for, honestly, is not to have swinging markets on one piece of data. The fact that the data came out, there's sort of a mixed bag, and the market is reading it as a mixed bag, as opposed to excellent news or horrible news, or we're just getting swung one way or the other. We're basically not moving at all, which I mean, thank goodness for that, huh?
Yeah, jobless claims data also came through. Last reading was 214,000. We ticked up to 217,000. Kind of split the middle between where we were a week ago and the expectation, which was at 220,000. So not a huge shock to the system there. We did get the ECB decision, right, Tom, at 75 basis points.
Correct. Yeah, and that was in line with expectations. Ben and I were talking about it a little bit. They did announce that they are still not doing any real effective quantitative tightening. They're going to continue to reinvest all the proceeds from all the bond purchases in what they call PEPP, the Pandemic Emergency Protection Program. So basically what they're doing is they're trying to fill the bathtub by they turn the knob a little bit more, so there's more water getting in the bathtub, but the drain is still open. So they're sort of trying to do two things at once. One is they're trying to use the bonds they've already got to continue to keep liquidity and bond prices elevated, but at the same time they're raising rates to lower bond prices and elevate rates. So it's a little bit of a mixed bag there as well, but they're doing what they have to do, because if they don't, odds are they'll probably end up in the same situation as England, where they've got imperiled pension funds and problems with liquidity. So sort of a mixed bag this morning from the ECB, but again, nothing that's really moving the needle or shocking the market anyway.
There's a ton of news coming right now, and we're just not seeing pronounced reaction, which honestly, I think given the volatility that we've had, I take that as a positive, at least in the hyper short term. We're talking about 7 minutes of futures trading, but I don't know. It's nice that we're not just getting kicked in the gut right now.
Yeah.
We do have lots of other news we're going to hit to, and we'll check back maybe on futures and where we are. Japan Tobacco and Altria starting a joint venture in the U.S. to go after heated tobacco units. Been maybe not at the forefront of everyone's mind, but a pretty competitive space, and looks like it's going to get more competitive.
Yeah, so this was interesting. Philip Morris had this ICOS platform that's been international, and they're going to take it to the U.S. beginning in 2024. Well, Altria just announced with Japan Tobacco that they're going to try something of their own. They're a lot further behind Philip Morris, and Philip Morris has done this in other countries and should be able to do it here in the U.S. But Altria clearly doesn't want to get left behind, but their core business is struggling. Altria's core cigarette shipments were down 9% this quarter, while Philip Morris's were flat. Philip Morris, again, international, Altria here in the United States. So Altria is just in a tougher position than Philip Morris, needs to reinvent itself, isn't reinventing itself as quickly as Philip Morris. When it tries to, it has failed with Juul, for example. So they're really trying to make this work, but it's a relatively small investment for the company. I think it's $175 million or something like that for 75% stake.
Let's jump to earnings. The big one, I think, probably today, you'd have to be looking at Meta, the company formerly known as Facebook. The stock is getting absolutely pummeled right now. It was down as much as 24% in after hours and pre-market trading. Right now, just down 22.7. Very, very tough quarter. Very, very tough commentary on the call. They're spending way too much money. It seems. Ben, walk us through kind of the state of Meta right now as you see it.
So I think that's a great place to start. I think you've got a management team that has retooled the company to focus on the metaverse. That's number one. Number two is you've now lost two of those more senior members of the management team in their respective roles. Sheryl Sandberg is no longer there. David Weiner's moving to who's the CFO, is moving to a different part of the organization. So that's the backdrop, which really just leaves Zuckerberg and his vision, and he's really just kind of an engineer by trade. What they're trying to do right now is battle on a number of fronts. Number one is they need to get more traction in their business and keep users engaged. They're succeeding with that. It's coming at a big cost because it means they have to invest a ton of money in artificial intelligence, something they haven't really had to do before, because before all of the content was just supplied by family and friends. Now they're doing artificial intelligence, requires a lot more money to do. They're going to have to invest a lot of money in that going forward. The second piece is they need to get advertisers engaged. Right now, a lot of large advertisers are pulling out of the Facebook platform The ones who are staying are the small businesses. So this does not bode well for the advertising market going forward. Facebook attributes this to macro pressures, but I'm concerned that this is a lot more due to low returns on investment on the Facebook platform, especially after Apple's ad tracking algorithm became unavailable. And the final piece is the investment in Reality Labs, which is their investment in virtual reality, augmented reality, and what Zuckerberg talked about as neural something about basically reading your brain, which is a big bet long term that they're going to be pouring money into. The problem is a lot of the excess expenses are being attributed to the metaverse. But the issue is, I think a lot of those excess expenses are actually attributed to shoring up the core business, and those expenses are not going away, which fundamentally decreases the value of the Facebook platform long term. And I think that earnings per share are probably going to be down 20 to 30% next year.
It's going to be a slog back. I think if you're holding Meta, you've got to either say, hey, we're going to make some changes and wait till we have confidence, or you've got to be very patient. This is not a quick turnaround.
We do have, as a firm, we do have quite small positions in Meta, definitely less than the market. But we will be strongly evaluating that today. And I wouldn't be surprised if we have much less by the end of the day.
Yeah.
Well, that's because it's going to be down 25% when the market.
Yeah, we have less than we had yesterday. So
yeah, the market's not even open yet.
Yeah, we've had a natural reduction in ownership. ServiceNow reported kind of opposite end of the spectrum as you're looking at some of these tech companies and what they're able to do. Operating quite strongly, up about 14%. Ben, this is a company you've liked for a while. How'd you feel about the commentary? I mean, they come out with a lot of energy on those calls.
And
McDermott gets hype.
And thankfully for clients on the calls, we have larger positions in ServiceNow than we do Meta, especially right now. The enterprise spending is really rewarding customers vendors who have efficient products that get value to you, that get you to return on investment quickly, and where you have a good relationship. And what Bill McDermott has done with that sales organization is really remarkable. What happened in Q2 was that deals started to get pushed out because you needed more and more approvals in order to get a deal done. They provide a lot of IT operations management software, expensive stuff. But what they've done is they've gone to people and say, look, we can retool your supply chain on this platform. You have a lot more visibility. You can make decisions fast, and we can get you up and running in max 3 months, probably a week. And a lot of these companies just jump on that, and for good reason, because it does make them more efficient. The other thing that they're doing is they're having their salespeople reach out to their customers much more frequently, because they want to get a better understanding of what approvals do you need? How can we get this deal done quickly? Which manager should I be talking to help you out get this deal done? And I think it seems very obvious, but I haven't heard anyone else talk about that. And I think that's very creative and flexible and adaptable management. And I think Bill McDermott's really shining right now. So good for him.
Caterpillar, nice kind of combination of very strong volume and very strong pricing. The pricing piece maybe not all that surprising given the inflationary environment we're in, but we are seeing Caterpillar start to really benefit from normalization within the supply chain. Stock's up about 4.5%. I think the company I was most surprised by, honestly, is Shopify, up 5%. A little bit light on volume, but taking a nice take rate.
I think what people are doing is these large companies are doing is they're saying, rather than spend money on Meta, let's make sure we actually get ROI on investment. So we're going to go to our vendor like Shopify, and when we make a sale, will pay Shopify 2%, but we're making money. We're not just throwing out a name into the metaverse. And I think that's the big thing that we're seeing. We're seeing people go from, oh, what's a good marketing budget item to have, to, we don't need this marketing budget item. We need sales. We need ROI. We're going to go to ServiceNow. We're going to go to Shopify.
Continuing kind of the tour of earnings, Southwest up about 4% on Southwest Airlines. They are seeing things come back on the business travel. They're seeing normalization after Hurricane Ian. They expect revenue to continue to accelerate. They are still facing cost pressure. It's continuing to be a battle. I don't really see that changing for them in the short term, but in the meantime, market responding pretty positively relative to what they've been able to achieve. Then we got a slew of other earnings. What you want to just do kind of high points on some of these?
I think the big thing is defense continues to be a little bit soft. Aerospace continues to be strong. Comcast, I don't know if Comcast is somehow up right now. I am shocked by that because they just lost 500,000 video subscribers in the last quarter. Again, people are looking at their budgets, and whether that's companies, whether that's consumers, and they're saying, what line item is just an item that's in every month that I can cut or renegotiate? And I think that's what we're seeing. And tonight we have T-Mobile, which I think will be an interesting one. I know we've owned Verizon in the past. So that'll be one to watch. We also have Apple, Amazon, Intel, and Pioneer Drilling, which is one of the largest U.S. drillers in Texas. So I'm really interested to see what happens with Apple and Amazon. I think Intel is going to be very, very bad.
Do you think the Apple taking a cut of everybody is going to be registering? Like that may actually be a windfall for them, where they basically just took everybody else's money, and that's going to be a big win for them.
I don't think you're going to see it in this quarter, but I think over the next few quarters, you're going to see that services revenue as a percent of total revenue tick up.
Yeah.
Which is going to be important because I don't know how strong an iPhone cycle this will be relative to previous cycles. I think it'll be a little bit lighter.
Yeah. There's
not
a lot
terrible.
A lot of mixed news on that.
So they need that service piece. I'm very curious and see what Amazon does too.
Taking a quick pulse, just earnings. We talked earlier in the week about just kind of where we were. Ben, you were hesitant to say the B+ range. As you kind of digest, I mean, almost the good, bad, and the ugly of it, you know, you try not to put too much weighting on a specific company, whether it's ServiceNow crushing it or Meta really blowing it. How would you kind of grade where we are at this moment in the earnings cycle?
I'd downgrade it to a B. I think people are boarding up the windows, and the reason that ServiceNow is doing well, I mean, ServiceNow is a phenomenal company, great cash flow, good business, but it's going to be a hard slog for them next year. And I think that you have this sugar high right now because of the earnings results, as you do in some of these other companies. I mean, I think even Caterpillar's in that mix. Great earnings, but what's going to happen in 2023 as people have battened down the hatches and we enter this recession? I think that's the concern going forward. So I would downgrade it to B because Meta is on the leading edge of seeing what I think other companies may see, not will see, but may see over the next 6 to 12 months.
Awesome. Following back up, right now, futures pretty much where they were. Not a lot of change, which again, 18 minutes after some of those big data points came out, it's not necessarily a bad thing. Dow futures up about 80 basis points. S&P futures, for all intents and purposes, basically flat, up a little bit, but NASDAQ futures down about 0.5%, which is slightly better than when we started the call. Obviously going to be hit by companies like Meta. We'll wrap it up there. We'll be back tomorrow morning at 8:30. Hope you guys have a great Thursday. Talk to you soon.